Hey everyone, welcome back to Yuri's Box. In this video, I'll be talking about TLT and the week ahead. If you like this kind of content, consider leaving a like and subscribing to the channel. And as usual, nothing in this video is financial advice. So really, the best place to start, in my opinion, is actually Foss98's comment. Has the US declaration of war changed your bond thesis? Funny story. I actually read this comment yesterday morning just as I woke up. It was one of the first things I read. And I was like, what the hell happened? I went to bed, you know, uh, you know, with the world in one state, and I woke up, and you know, in complete, amusement, really. So the short answer is no. I've often, spoken about, some of the potential downsides to, bonds in particular, and that, I often talked about also what would happen if we were to see, for instance, what happened in 2022, all right, this time around. And I think that 2022 we might start seeing certain narratives get spun about 2022. And basically, what happened back then? Well, Russia invaded Ukraine. You had a huge oil spike, up until $130 basically, and that was one of the drivers of inflation. Now you have the U.S. basically entering the war, and then I've been treating it as a war, for quite a bit. We're no longer exchanging firecrackers, as I said, as we were last year. But again, as the U.S. enters the war, this could put upside pressure to oil. All right, simply because a good chunk of the supply of crude is comes through the Middle East. So any kind of disruption would be hugely negative for positive for the supply of oil, of course, negative for inflation potentially, meaning it could actually spur and cause outbursts of again inflation. Now, the reason why I think that these two events are different in nature is, again, it comes back to the labor market, and it comes back to people's ability to spend and absorb increased costs. All right. And again, it goes back to the simple idea of what did we have in 2022? Well, we had an imbalanced economy, an imbalanced labor market, rather, where, just by looking at job openings as a proxy for labor demand, we were just shooting straight up. And at the same time, we really didn't have, available workers in the aftermath of the pandemic. That put the labor market in a position where employees had leverage, meaning, again, demand was outpacing supply. So if employees have the leverage in the labor market, you can expect wages to move up. All right. Oh, with this one here, this is what I was looking for. And again, that is exactly what we saw back then. All right, the peak in average hourly earnings came in February of 2022 at 7%. Coincidentally, that is when we saw the peak in the quits rate. All right, right here. So what does this tell us? Well, again, it tells us that if you have a labor market that is accommodative for really employees, meaning that employees can use the labor market as a tool to push up their wages, inflation can become a problem. Now, it's also important to remember that 2022 was quite a peculiar year. We also had huge injections of stimmy checks and all that good stuff as a consequence of the COVID pandemic. So that also played a role, of course. But to me, at least, it all comes back down to the labor market. All right, what we had in 2022, we don't really have today. We have labor demand, as you can look at, again, job openings as a proxy for that. is has definitely cooled off. The quits rate has cooled off quite a bit, and at the same time, ignoring initial claims for a second, you have continuing claims breaking out to cycle highs. Now, again, at a historical level, we're nowhere near even the lows of the 06-08 cycle. But regardless, as far as the pre-pandemic norm is concerned, we're back to 2017 levels, if not 2017 levels. So what does this tell us? It tells us that we're probably on the other side of the spectrum when it comes to the labor market, meaning we're no longer in a situation where demand is outpacing supply. We probably have a little too much supply, as hinted by the continuing claims, meaning that people are finding it harder and harder to find a job. As a consequence, people won't take risks in the labor market. It has become an employer's labor market, meaning that the leverage has gone from the employee to the employer, meaning that even if inflation goes up, employees don't have the labor market as a tool. They don't have it in their toolkit to really try and keep up with that inflation, meaning they can't use it to push their wages up. All right, and so how I've often spoken about a potential move up in oil, potential increase in inflation, is that it would likely be a form of, if you will, disinflationary inflation, meaning that the example I often talk about is, again, 2008, where you get to a point, and honestly, this is consistent with other recessions as well. Inflation goes up, and it immediately just plummets down, because again, it's all you're doing is you're squeezing, people's, families' balance sheets, if you will, where they have steady wages but increasing costs. So all that's doing is that they're reducing the amount of discretionary spending they can do, and that is also true for businesses. If a business knows that its customers really they don't really have a way of increasing wages, what will happen is that revenues will likely stay flattish. Prices will continue to go up if there is a pattern of inflation, and all you're doing is you're squeezing margins. All right. And again, what does that cause? Well, as far as businesses are concerned, eventually they'll get to a point where you'll have to start laying people off. And that will actually start the second part of the recession, really, where the first part is kind of a stasis, a freeze, if you will, where you have low firings, but you also have low hirings. And eventually, if things get bad enough, that morphs into what everybody really associates recessions with, and that is loss of jobs. And again, just to reiterate on inflation, if you look back to 2000, we saw the exact same dynamic play out, where inflation was a problem. It was a problem for quite a while. It was sticky at 3.6. Then everything kind of goes downhill, and you have basically you go back down to 1% inflation. You have similar dynamic play out in the 1990s. All right, you also had war in 1990. You also had the Gulf War, the invasion between Iraq and Kuwait, the coalition with Bush and all that good stuff. Inflation at 6%. Just give it a few months and it goes back down to 2.8%. You get the picture, really. So to me, I've spoken about it, and probably not that much, but I have mentioned a rise in oil and how that could affect bonds. Really, if you do see growth take a tumble, meaning that as you see, if we continue to see this, economic data come in lower, growth start to come in lower, that should translate into lower oil prices. But at the same time, if you do have geopolitical risks rising in, especially in the Middle East, where a good chunk of the supply comes from, that'll probably economic data for oil will likely take the back seat, and that is actually a good segue for TLT. Really, this week we do have data coming out. The problem is that it will likely take kind of, again, the backseat as, you know, meaning that what will be in the driver's seat will likely be, what comes out from the White House. All right, we're in a similar dynamic where you remember the tariff drama. All right, to some extent that played out where we had economic data coming out. We had we're talking about analysis, technical analysis and all that good stuff, but what eventually decided where prices would go for TLT was really what was coming out of Trump's mouth, all right, from day to day. We could be in a similar situation, right, in this week right here, okay? Keep that in mind. Today, we do have the PMIs coming out. Now, again, should they have an effect? Absolutely. If they come in stronger, I expect TLT to suffer. If they come in weaker, I would expect TLT to be rather accommodative of that. At the same time, if you have the PMIs coming in soft, but Trump says, I don't know, I want to bomb Beijing, something like that, what will take, what will have the right of way will be, the geopolitical risks. All right. So again, it's important to keep that in mind. We also have some housing data. Overall, I think that the main event is today at this afternoon or this morning, according to where you are, and on Friday, as we have PCE coming out on Friday. Now, CPI and PPI came in relatively benign, so we shouldn't see huge surprises to the upside again. Something benign, but again, let's see how that comes out. As far as the rest of the week is concerned, we do have some Powell speak, some read on orders and GDP data, as well as Chicago Financial Activity Index. If I'm not mistaken, we also have regional. Yes, I was looking for those regional surveys as well. And Richmond Fed, we have the Conference Board Consumer Confidence coming out, and the University of Michigan on Friday. So we do have some data coming out. I will be looking at the state of initial jobless claims and continuing claims to see if they continue to stay at their current elevated level. But again, the main events will be likely today with the PMIs, and I'll be covering those in a separate video, and PCE on Friday. All right, another read on inflation. Now, overall, again, what does this mean for TLT and bonds? Well, as I said in the first part of the video, it doesn't really change my outlook on bonds, my interpretation of the chart, and how I'm going about when thinking about bonds in general hasn't really changed. And the things that will really make me change idea and outlook on bonds is some kind of policy shift, be it by the Fed or by Congress. All right. We've all read the headlines about deficit spending is out of control in Congress, and the big beautiful bill is going to cause trillions and trillions and trillions of spending, and that's going to cause incredible stimulus in the economy. As far as I can tell, and again, this is just my kind of rationalization of it, is that most of it is just renewing current conditions, meaning the TCJA, the tax cuts that came in force in 2017 and 2018. And so really you're just avoiding a negative shock to the economy with a tax increase. And on top of that, you also have tariffs. Tariffs, we don't really talk about tariffs anymore. They're no longer in the news flow, but we have tariffs and there are tax, and that's taxes, generally speaking, aren't growth friendly. All right, so as far as the fiscal side is concerned, the big beautiful bill doesn't seem to be what everybody is kind of pointing towards. What could be that kind of catalyst for me changing my mind on the fiscal side? Well, STEMI checks. When you start hearing Doge dividends, direct transfers to people, to citizens, that's the kind of stuff that wants to make you run for the hills for TLT. All right, I would not want to own bonds in that kind of an environment. And on the monetary side, if the Fed next month comes out and does, ZERP, go zero interest rate policy, mixed with extensive QE, extensive money printing next month, at that point I would say, you know what, TLT is likely not gonna not gonna have a fun summer. But again, as I've been hinting toward in my videos so far, again, as long as this is what we have to deal with, this is not supportive of a strong economy, of a solid labor market. Labor market is probably still hanging in there, but the only reason why it's still hanging in there is because mostly due to uh, people's perception of how this sort of stuff evolves. You don't immediately just fall off a cliff and go to layoffs. What you have is again a period of time where you have, yes, slow layoffs like we have right now, but the problem is the hirings that you start to see kind of become lackluster. In 2006 and 2008 we were going up and up and up and up. Then we kind of leveled off, stagnated, and eventually that kind of mutated in it had a mutation into, again, the layoff cycle commencing. Today, again, we had an uptick in the level of hires, but again, if you look back at history, we're again back at 2017 levels, all right, and the low that we saw right here in May was effectively us going back to 2014 levels of the economy. So again, we are far away from the economy, the labor market that we had in 2022 and 2021. So again, as long as this is the labor market we have to work with, I would maintain my positive outlook on bonds. And again, just to reiterate, what would cause me to change my mind? Some kind of significant policy shift, meaning some kind of big stimulus package, and on the fiscal side, or monetary stimulus, by the Fed with QE and zero interest rates, all that good stuff. That would make me change my mind. Oil going up is just, one of those scenarios where, yes, you could have goods inflation going up, but because the labor market doesn't really allow people to, push their wages up, all you're doing is compressing people's ability to spend, and as a consequence, business margins. Right? That's kind of those are my assumptions going into this. So again, what does this mean for TLT? Well, to me, the best thing you can do, especially when it comes down to geopolitical events, is just try to ignore again the headlines on all the Iran and the strikes going in, because again these things could end on a moment's notice. We could have the worst case scenario, we could have the best case scenario. It all really depends on the people involved. You could have a post on Truth Social and it could end all at once. You could have Trump come out and say we're going to bomb Beijing. I mean, you have absolutely no idea how this sort of stuff can play out. And again, I don't assume and pretend to know how these things will play out. And probably if people actually try to tell you that they know how they'll play out, they're probably wrong, or probably get lucky in case they they do get it right. So try to, in my opinion, ignore as much as possible these the headlines on all the developments in the war, and really focus on the data, because I think that in terms of economic data, that will tell you even how these geopolitical risks could play out in the economy. Again, if the economy continues to be, as we've been pointing out, as the PMIs have been pointing out, all these regional reports, we read the Philly Fed last week, We'll see Richmond Fed this week. The PMIs have been kind of lackluster. Again, regional surveys, not great to say the least. If this is what continues to take place, even an upside surprise to inflation will just pour more fire on the slowing of growth, if you will. All right. So again, in this environment, as far as I'm concerned, it really pays to pay attention to the data. Okay, pay attention to the reports. I'll be going over the PMIs. I'll be going over the regional surveys, the best of my ability, and we'll see how things evolve. And if things change, I'll be the first to change my mind. But so far, and I stress so far, we're still far away from the events that would cause me to kind of flip on TLT really. So I'll leave it at that. Hopefully you enjoyed this kind of video and this content. If you did, leave a like, subscribe, and I'll see you next time.